With the big monthly CPI print on Wednesdays, investors are going to be laser focused on any clues as to tariff-related inflation. But stepping back, what is the biggest driver of moves in stocks and bonds? Jobs, CPI, or the Fed itself? Today, we're going to check the scoreboard. I'm Jared Blickery, host of Stocks in Translation. We're going to show two charts with each of the three big market movers going back to the start of the October 22 bull market. And we start with the S&P 500, America's benchmark stock index. Blue here shows the cumulative market reaction to non-farms payroll jobs data, the big monthly numbers. In green, we have the reaction to consumer price index reports, and in orange is the running total for Fed decision days. Finally, in white is the S&P 500 itself. Now, the inflation and jobs report, they come monthly, and the Fed meetings happen about every 6 weeks or so, so this makes their lines all look like stair steps. Since October of 22, green CPI days dominate with a 16 percentage point market gain. That is over 6 times the jobs day boost and more than wiping out Fed day drags, which clocks in at a negative 3%, by the way. But zoom in since Trump's election last November, things shift as quickly as those tariff announcements themselves. Jobs data turned from boost to burden. The blue line is down 5 percentage points from there. CPI went up, then down, but net, it is flat, offering almost no relief since November and introducing a lot of volatility, by the way. And orange Fed days, they are still dragging stocks lower. On net, 2 recent reports drove home some of this new bearish mood. The April 5th jobs report, the huge blue drop towards the right, it showed modest job gains, but stocks sold off hard. They were piling onto those post-election weakness vibes. Also, the April 10th inflation report, which caused a big green drop right at the top right, a negative headline print for inflation was not enough. Stocks slipped further, and instead of cheering the cooling inflation, investors feared slowing growth, worrying about the dreaded R word. That would be recession. Now, let's take a look at how the bond market reacted to these very same reports with the 10-year yield. Why watch it? Trump 2.0 cares more about stocks than bonds this time, and yields signal whether his growth plans get traction or trouble. Rising yields mean higher borrowing costs and maybe more Fed hikes. Modestly lower yields are okay for risk markets, but if they drop too much, that is actually a sign that there are doubts about the reflation trade and that the economy is in trouble. So looking back to the chart, we have orange Fed days. They are the big bond movers here, pushing the 10-year in white down 98 basis points overall. But notice that the blue jobs data since November, adding 26 basis points, signaling new worries that a tight labor market means sticky inflation and more Fed action. In fact, on Friday, just a few days ago, the monthly jobs numbers drove the 10-year yield up 10 basis points, the most since that April 8th market plunge. All in all, jobs set the tone for yields, inflation steers stocks, but the Fed makes the rules. So mark your calendar. CPI prints Wednesday at 8:30 a.m. Eastern. Another big stair step might be coming on some of those green stairs. Tune in to more Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.